Most people just look backwards at their tax situation. In the spring, they collect all their documents about how much income they earn and whatever. In the past, last year, they use that to compile a tax return that shows what happened last year. Looking backwards isn't enough. You need to look forward with your taxes. You need a multi-year tax plan. I'll explain coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Cohorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. I'm meeting with an individual recently, high net worth, and really down to earth, nice guy. And we're talking about his situation. And in about 4 years, he's going to be forced to start drawing money out of his IRA. And because of how much he's sacrificed over the years, he and his wife, they've saved up a significant amount of assets, and they really don't need to draw out this required minimum distribution to live on. So it's just sort of excess. Well, I told him, we had a meeting recently, and I said, listen, we need to start planning for what to do as we get ready for required minimum distribution. If there's any ways we can reduce it or want to reduce it. And in order to help us figure that out, you need a multi-year tax projection. We need to take a look at last year's taxes, project out what we think they'll be this next year, and the following year, the following year, the following year, and kind of project it out over as far as we can see. And he said, boy, don't you know how to have fun? Which yes, that is fun to me. Building a spreadsheet and mapping out numbers and then extrapolating them in the future to see what might someone's tax bill be, minus certain deductions, and then what the tax rates are. That is the definite fun for me, okay? I tell you that I am a nerd, and for this individual in his late 60s, he's much cooler than me, and I appreciate the joke because it sounds so boring. But let me tell you why you need that. It doesn't mean that you've got to go build it. If that doesn't sound like fun to you, that's fine. That's fine. It probably means that you need a certified financial planner where that is fun, where they do love doing that sort of work and they can do it on your behalf and then sort of share with you, hey, this is what it means. This is what this is telling us. Therefore, these are some of the things you should consider doing, okay? The first reason I think of when considering, well, hey, you need to do a multi-year tax projection is a Roth conversion. Now, this is when you, in the past, have taken dollars and contributed pre-tax into your 401k, IRA, something like that. And you've gotten the deduction in the past. Maybe it's your employer match that's never been taxed. Maybe you have a pension that's lump sum that's never been taxed. It's pre-tax. Well, you can kind of project in the future, all right, when you start drawing this money out, you'll have Social Security, you'll have this pension, you'll have these dividends, this income, blah, 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 and your tax bill, your tax bracket will be. Does it make sense today? Are you in a low enough tax situation today and low enough tax bracket today that when we project that out in the future, you should voluntarily convert those dollars, switch them from IRA to Roth, which is a taxable event. So you're choosing to pay tax today on those dollars so that you don't have to pay tax on them in the future. They'll grow tax-free. Well, one of the ways, that sounds like a good idea. In the vacuum, sounds great. But if you're not projecting out what your tax picture will look like out there in the future, out there in retirement, how do you really know? How do you know? And you might listen to this whole thing and say, how do you know what tax rates will be? How do you know what deductions they're going to allow? How can you actually project out someone's taxes? Yeah, I don't know the rules. I won't know what the rules will be. We don't have a crystal ball. However, you can still plan based off of today's rules and look and say, okay, out there in the future for this individual, out there in the future, you're going to be in the 24% tax bracket. Your income's going to be about $275. What are the chances that in the future you'll actually pay a higher tax rate than 24%, which is today's dollars, on that much income? Do you think tax rates will be going up or not? Then we talked about the IRMA, the increase in Medicare Part B and Part D expenses because your income will be that high. So there's still, even though the future tax rates and future tax rules are unknown, there's still value in projecting out and then drawing some conclusions off of that projection. So the first is should I do a Roth conversion? A second idea is, should I actually contribute pre-tax or Roth? Right? If you've got an event coming up, if you received an inheritance, if you've got a big bonus at work that's being paid out to you, something like that, you can project out in the future. If you've got stock options or something like that from your company, maybe you do sales or something, they've given you some stock options, and that's going to create some tax in the future, you can do a multi-year tax projection, say, well, pre-tax here, or Roth here, Roth here, Roth here, but then this year we got to switch it to pre-tax because we're going to have a different tax event show up. So determining pre-tax or Roth, a multi-year tax projection helps you with that. What about capital gains harvesting, capital loss harvesting, tax loss harvesting, something like that? So if all of your investment savings have been in pre-tax or Roth tax sheltered accounts, wonderful. But if you've had additional dollars saved up into non-IRA investments, so an individual investment account, a joint investment account, a trust account, something like that, then those dollars are growing taxable. And sometimes, especially after the growth we've seen over the past decade, you can have a lot of growth that you'll eventually have to pay capital gains tax on. Well, it just so happens that in these laws, these rules right now, some of those capital gains, depending on your income, are taxed at 0%. Some of them are at 15%, some are even higher. And using a multi-year tax projection, you can determine, you can plan out, hey, it makes sense for us to sell a little bit here because we could pay 0% tax on that. It makes sense to sell a little more out there 2 years from now because we could pay 0% tax on that. Or if you've got an investment that maybe has gone down in value and you've got a capital loss, you can plan out, all right, if this investment doesn't recover, here's the time where we're going to want to capture that loss. Only can be seen from a multi-year tax projection that then as rules change, tax laws change, you can just update it and improve your forecast. And the final main reason why I would say you need a multi-year tax projection, if you own a business or if you own rental properties. There's no question, if you have either of those, you've got income sources that the rest of us don't have, and they're more variable, okay? So some years it's really high, some years it's really low, some years it's a loss, and you've got to project out, okay, and not to mention, some years are really high, some years really low, some years there's a loss, and then at some point there's going to be a sale, a distribution, some sort of liquidity event that's going to impact your taxes. You need to project out when that might be. That helps determine Roth conversions, pre-tax or Roth, whatever. And so projecting out where your income will be from those passive investments, that rental real estate, that business that you own, projecting that out helps you make great, fantastic tax decisions, financial decisions today. And that's really what it's all about, planning. That's what it's all about. Planning's not about trying to predict the future. Planning's trying to make great decisions today, considering all of your choices and then saying, these ones aren't good, these ones are just good, these ones are great, these are the ones that we need to capture. That's why you do planning, okay? So your certified financial planner should be delivering confidence, clarity, but also creative ideas, and that planning work, projecting out what things might look like, especially on your taxes, helps them deliver creative ideas to you. So if you're not getting a multi-year tax projection and you have a scenario that fits in one of those 4 or 5 that I just mentioned, talk to your certified financial planner. If they don't do it, they're not an expert in tax planning, then you don't have a financial planner. You might think you do, but you don't. You need a certified financial planner doing comprehensive financial planning. I've got a whole team of them here at KFG, so you can always reach out to us. You can find us online, Korhorn.com, that's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.